Hello everyone. In this video, I will start talking about after-tax salvage value. As you know, for net capital spending, like all the equipment and fixed assets, once reaches the end of its useful life, if there is a market price for the equipment, for example, the firm can sell it in the market and get some cash inflows. Those value called the salvage value. And then if you have a profit from this selling of equipment or plant, those fixed assets, you will have to pay tax. And we need to include the after-tax salvage value into the cash flow from assets. So if the salvage value is different from the book value of the assets, there's a tax effect. And the book value equals to the initial cost, which is the capital expenditure minus accumulated depreciation. So over the whole tax years, like over the whole useful life of this equipment. And the after-tax salvage value equals to salvage value, which is the market price. So here, this salvage value is the market price, the price of the equipment or plant. At the end of useful life of the fixed asset. So here is one example. If you purchase equipment for $100,000 US and it costs you $10,000 to have it delivered and installed. So the total capital expenditure is this $110,000 US. Based on the past information, you would believe that you can sell the equipment for $17,000. And the useful life is 6 years. And the company's marginal tax rate is 40%. Then what's the depreciation each year and after-tax salvage value in year 6? So the net capital spending is the price plus the installment cost, because this installment cost is incremental cash flows. Only because you buy this equipment, this cash flow happens. So we should include it in our analysis. Depreciation, we use this $17,000 US as the end value when we do the depreciation. So this is the net capital spending, subtract the end book value and divide by 6. So each year the depreciation is 15,500. So the book value after 6 years will be 17,000. This is the book value after year 6. And after tax salvage value will be equals to the market price minus tax times market price minus the book value, and this book value is 17,000. If finally you sell it at this 17,000, then you do not need to pay any tax because you didn't make profit from it. So your after-tax salvage value will just equals to your book value and equals to your market price. And this is a cash inflow to you, so we need to add this after-tax salvage value in the cash flow from assets. That is part of net capital spending. So one example, total depreciable cost is 90,000. Changes in net working capital, 20,000. inventories will rise by 25,000 and accounts payable will rise by 5,000. So effect on operations, this new project will have new sales 50,000 units per year at $4 per unit. Variable cost $2.5 per unit, and the fixed cost is 12,000. So what's the life of the project is 3 years. Depreciable life, we will use straight line to depreciate to 0. And the tax rate is 30%. So this is a summary of all information. The revenue will increase to 50,000 units, and each unit price is $4. So which means the revenue will be $4 per unit times 50,000 units. That is 200,000. Variable cost is $2.5 per unit, and the total unit sold is 50,000. So the variable cost in total is this $2.5 per unit times 50,000 is 125,000. And then the gross profit is 75,000. The fixed cost is 12,000. So we subtract the fixed cost, and the depreciation, remember the price of the equipment is $90,000. It has a 3-year life. So the depreciation each year is 90,000 divided by 3. It's 30,000. So earnings before interest and tax is 33,000. Tax rate is 30%, which is so the total tax is 30% times 33,000 equals to 9,900. So this is the net income. And the net working capital. So here it's overlapped. I will just erase this. So when the net working capital at t equal to 0, it will increase from 0 to $20,000. And at year 3, it will drop from $20,000 to 0. And the net fixed assets is 90,000. So this is the book value. You spend 90,000, so at the balance sheet, you have the 90,000 net fixed asset. After a year, you will depreciate 30,000, 1/3. Then the book value will change to 60,000. And year 2, the book value changes to 30,000. And at year 3, the net fixed asset, this equipment is fully depreciated. So the book value becomes to 0. The total assets at date 0 is 90,000 fixed assets plus those 20,000 invested in inventory in current assets. So the inventory, remember, is 25,000. And then there's accounts receivable is 5,000. So which means for those 25,000, there's 5,000 and you own the suppliers. So it's not a cash outflow. It's not so that's the reason why when we consider the net working capital, it's 20,000. It's the difference between current assets and the current liability. So it will increase from 0% to 20,000. So you buy 25,000 inventory, but out of this 25,000 US dollar, $5,000 you didn't pay the supplier. That's a debt. Then we need to estimate the cash flows over these 3 years. First, we calculate the cash flow from assets for t equal to 0. Operating cash flow is 0 at t equal to 0. When you buy the assets, it doesn't generate revenue immediately. The incremental net capital spending, that is the equipment you paid, that's the cash outflow, it's 90,000. The incremental changes in net working capital is 20,000. So the beginning in this project is $0, and then you buy inventory, you own some to your suppliers, but the rest you have to pay. The payment, the cash outflow is 20,000. So the incremental changes in net working capital is 20,000. The cash flow from assets will be operating cash flow 0 minus net capital spending minus the changes in net working capital is negative 110,000. For year 1 to year 3, the incremental operating cash flow equals to earnings before interest and tax, and add depreciation and minus tax. So it's 53,100. Incremental net capital spending, there's no net capital spending over these 3 years. The incremental changes in net working capital for T equal to 1 or 2 and 2, those are just there's no changes in net working capital. You can see it's 20,000 for year 1 is 20,000, for year 2 is 20,000. 20,000 minus 20,000 is 0. So changes in net working capital is 0. From year 2 to year 3 is 0, 2. And for year 3, finally, at the beginning, it's 20,000. But then at the end, this is the beginning of year 3. At the end of year 3, you will sell all the inventory. And then you have to pay your suppliers. So your current, the net working capital equals to 0. So the changes in net working capital will be 0 minus 20,000 equals to negative 20,000. So the cash flow from assets equals for first 2 years will be this, and remember, just equals to operating cash flow because no capital spending, no changes in working capital, net working capital. For year 3, the net changes in net working capital is negative 20,000. So the cash flow from assets is 73,100. So this is the cash flow tables. So for operating cash flow, first year you have the 53,100. For year 2, year 3, we all have this operating cash flow. The changes in net working capital at T equal to 0, you have invest in inventory, so it's 20,000. And year 3, you will sell all the inventory and you will pay your suppliers. So both inventory and accounts payables will drop to 0. So the change in net working capital is 20,000. And the net capital spending at T equal to 0 is $90. From year 1 to year 3, there's no purchase of fixed assets, no capital spending. So the cash flow from assets looks like this. So we plot a timeline. That's the cash flow for the project. After T equal to 0, you invest 110,000. T equal to 1 and 2, the cash flow is 53,100. And for year 3, the cash flow is 73,100. And then once you have this weighted average cost of capital estimate, we can use a lot of investment criteria we'll talk in chapter 11 and determine whether we should accept or reject the project. Another example, this is a replacement This is a replacement example. So the original machine has the initial cost of 100,000. The annual depreciation is 9,000, purchased 5 years ago. Book value is 55,000. Salvage value today is 65,000. So you have to calculate after tax salvage value. And salvage value in 5 years, after 5 years, will be 10,000. And the new machine, if right now we want a new machine, so let's draw a timeline for the old machine. So for old machine, right now is this is -5. 5 years before you spend 10,000 US dollar or 100,000 US dollar, and the depreciation over the 5 years. This is today is 5 year times 9,000. So in total is 45,000. And then the book value today, what you left is 55,000. And after 5 years, the depreciation is 5 times 9,000 again, is 45,000. So the 5 year, then after 5 years, the salvage value will be 10,000. This is book value, and the market price today is 65,000. So this is the old machine. And right now there's a new machine and they want to replace it. The initial cost is 150,000, 5 year life. Salvage value in 5 years is 0. The cost saving, so by using this new machine, this company will save $50,000 US dollar per year. And the depreciation will use 3-year MACRS. The required return, which is weighted average cost of capital, is 10%. The tax rate is 40%. And we're only interested in incremental cash flow, which means using this new machine, we can save $50,000 per year. That is incremental cash flow. So first, estimate the cash flow from assets for t equal to 0. The incremental operating cash flow, no, because the new machine, you cannot use it immediately. The incremental net capital spending, you need to buy the new machine today, which is 150,000. And you can sell your old machine and your after-tax salvage value. Remember, this is market price. And the profit by selling at the market price is 10,000. So you have to pay 4,000. You have to pay 4,000 tax. So the after-tax salvage value is 61,000. This is the cash inflow. So the incremental net capital spending will be, you have a cash outflow, but you have a cash inflow. So the total cash outflow is 89,000. And the incremental changes in net working capital, it doesn't mention, so it's 0. So the cash flow from assets for this replacement decision is 89,000. It's negative, it means it's cash outflow. So calculate the cash flow from assets from t equal to 1 to t equal to 5. So remember, cash flow from assets equals to operating cash flow minus net capital spending minus changes in net working capital. So we need to find out operating cash flow first, equals to EBIT, add back depreciation minus taxes. So the depreciation for the new machine, it's depreciated over uses 3-year modified accelerated recovery system. So this is the rate. And the equipment purchasing cost is 15,000. So the first year depreciation is 49,500 and keep going. And the income statement. So the cost saving each year is 50,000 over the next 5 years. The depreciation, the new depreciation is this amount. The old depreciation is 9,000. So the incremental depreciation is the difference between those two. Because you will do the depreciation for a new one, but you will save the depreciation for the old one. And the earnings before interest and taxes will be the cost saving subtract the incremental depreciation. So we get this line. And we have to pay tax, and if it's negative, that's a tax credit. And then finally, we can find the net income. So those are net incomes for over the next 5 years, incremental net incomes. And the incremental net capital spending, so the book value of new old machine at year 0 minus 5 times the depreciation is 10,000. Those are at last year. So if you do not replace the old machine at year 5, you will have a cash flows by selling it. This is the cash inflows. The after-tax salvage, which is your opportunity cost, and you have to include in your analysis, will be this 10,000 times this 0.4 times 10,000. You will sell at this 10,000 and minus 10,000. So again, the after-tax salvage value is 10,000. That's your cash inflows. And there's no change in net working capital. So EBIT minus tax, which is net income, those are what we get here. The depreciation, we add it back. And we found the operating cash flows, and the net capital spending at t equal to 0 is this. And at t equal to 5, that is a negative number 2. Because we sacrifice this opportunity cost. We lost the cash inflow equals the cash outflow. No net capital spending, so that's a cash flow from assets. So this is the cash flow from assets for this replacement decision. Here, this is the net income. Here is the incremental depreciation. The third example, the total depreciation cost, depreciable cost is 240,000. Equipment is 200, and the shipping and the installation is 40,000. Changes in net working capital is 20,000. Inventory will rise by 25,000. Accounts payable will rise by 5,000. This is very similar to our first example. Effect on operation, new sales is 100,000 units per year with $2 per unit. Variable cost is 60% of the sales. The life of the project is 4 years, but we will use MACRS 3-year schedule. And the salvage value, 25,000, tax rate 40%, weighted average cost of capital 10%. So of course, we need to calculate cash flow from assets equals to operating cash flow minus net capital spending minus changes in net working capital. Again, try to refresh your memory. Net working capital equals to current assets minus current liability. So calculate the cash flow from assets for t equal to 0. First, the incremental operating cash flow is 0. Incremental net capital spending, the equipment cost is 200,000. Installation fee is 40,000. So the total capital spending is 240,000. That's the cash outflow. The incremental change in net working capital, inventory increased by 25,000, partly by assets payable. So the change in net working capital is from 0 to 20,000. So it's 20,000. Cash flow from assets at t equal to 0 is negative 260,000. The cash flow from assets for t equal to 1 to year 4. Again, we use the same formulas. So first we need to determine annual depreciation expenses, and then calculate earnings before interest and taxes, then calculate annual operating cash flows. So first we need to calculate the depreciation expenses. The price of the equipment is 200,000 and installation is 40,000. So the total depreciable cost is 240,000. And the depreciation schedule looks like this. So the depreciation is corresponding from year 1 to year 4. And the operating cash flows equals to earnings, EBIT times 1 minus tax and plus the depreciation. So the revenue is units sold per year, and times the price per unit, and it equals to 100,000 times $2. So the total is 200,000. Here is the typo, it's units. Operating costs excluding depreciation is 60% times revenue, so it's 120,000. So we find out the depreciation. We fill this depreciation here over those 4 years from our previous table. We calculated here. So revenue minus operating cost minus depreciation expenses, that's earnings before interest and taxes. If it's negative, which means that we can get a tax credit, tax rate. So we know the tax rate here. Just don't want to show where we get this information. Tax rate is 40%. And the depreciation is where we calculated here from year 1 to year 4. From year 1 to year 4. Tax rate, tax is 40% of the EBIT. And then we use earnings before interest and taxes minus tax, that is net income. And we add back depreciation, that is operating cash flow. No capital expenditure for year 1 to year 3, but for year 4. So the cash flow from assets from year 1 to year 3 will be just equals to operating cash flow. So those 3 numbers. But for year 4, we have after-tax salvage value. Our book value is 0 because we depreciated to 0. The salvage value is 25,000, so that's the reason we have to pay a tax. And after-tax salvage value is 15,000. That's a cash inflow. And the incremental changes in net working capital, the inventory will reduce to 0, and the accounts payable will also reduce to 0. So at t equal to 4, inventory will be sold. Inventory level will decrease by the same amount. Payable will be paid. So the net working capital down from 20,000 to 0. So the changes in net working capital is 20,000, but it's negative. So the changes in net working capital will from 20,000 to 0 at year 4. So we found the cash flow from assets is 89,720. So then we can draw this timeline. The cash flow from year 1 to year 4 is what we calculated from previous slides. For t equal to 0 is negative 260,000, negative 260,000. And the interest rate or discount rate is the weighted average cost of capital given at the first page of this problem is 10%. So okay, that's basically chapter 10. And in the next video, I will just show you some practice, the solution of some practice. And in chapter 11, we will use those cash flows, projected cash flows, and weighted average cost of capital to make decisions. I will introduce some investment criteria to make decisions based on those projected cash flows and weighted average cost of capital, whether we should accept the project or reject it. Thank you for watching. Bye.